Benjamin Graham built his ideas in an age of steel, railroads, and tangible assets, when value was measured by what you could count, weigh, or touch. But today, the world's most valuable companies own almost nothing physical. Apple's greatest asset is not its factories, but its ecosystem. Google's power lies in algorithms, and Meta? In human attention. So here's the question. Can Graham's rules, written nearly a century ago, still guide us in a market built on code and clouds? In this video, we'll explore how Graham's timeless principles reveal what these tech giants are truly worth, and why understanding that difference may be the most important investing lesson of our time. Investors today celebrate what they call asset-light businesses, companies with few physical holdings but immense market value. They say tangible assets are old-fashioned, that value now lives in brand power, intellectual property, and data networks. And in some ways they're right. But Benjamin Graham would remind us that while the world evolves, human nature doesn't. The objects of speculation may change, but the psychology of speculation never does. In his time, people overpaid for factories, railways, and industrial trusts because they believed growth would never end. Today, they overpay for digital platforms, believing that user growth or innovation alone guarantees perpetual profit. Different century, same delusion. What Graham taught, and what we've largely forgotten, is that value is not a story. It's a relationship between what a business earns and what you pay for it. When that relationship stretches beyond reason, even the strongest story eventually breaks. That's what this video will uncover. How Graham's framework for rational analysis, built on earnings power, intrinsic value, and margin of safety, still applies to a world where most assets are intangible. You'll see why his logic cuts through the complexity of modern valuations, and how it can still protect investors from the illusions of the digital age. Because beneath every technological revolution lies the same question Graham asked nearly a century ago. How much is this business really worth, and how certain can we be? By the end of this video, you'll not only understand how Graham might analyze today's tech giants, you'll see why his principles are more relevant now than ever before. To understand how timeless his logic truly is, we first need to return to his world, a world of factories, ledgers, and balance sheets written in ink. Because only by understanding where Graham came from can we see why his ideas still illuminate where we're headed. It's the early 1930s. America is reeling from the Great Depression. Factories stand silent, banks have collapsed, and millions of ordinary people have seen their savings vanish overnight. The stock market, once a symbol of progress, has become a monument to human folly. In that shattered marketplace, Graham began to rebuild the idea of investing from first principles. He looked not to the excitement of the trading floor, but to the quiet logic of arithmetic. He asked simple, almost childlike questions that no one else was asking anymore. What does this company actually earn? What is it really worth? And how much am I paying for it? Back then, the answers lay in physical things, machinery, inventory, real estate, rail cars. You could walk through a company's factory and see its value. A balance sheet was a map of tangible wealth.
But Graham wasn't blinded by the concrete world he lived in. Even then, he encountered businesses whose value couldn't be neatly captured by book value alone. Companies with brand power, distribution networks, or special advantages that weren't reflected on paper. He called these intangible factors, and though he was cautious, he never dismissed them. What mattered to him was not whether an asset was tangible, but whether it was trustworthy. And that distinction between the visible and the verifiable is the bridge that connects Graham's era to ours. Because today's markets are filled with companies whose worth depends almost entirely on invisible assets, algorithms, software, user bases, and brand loyalty. The temptation is to say, Graham's ideas don't apply anymore. His world was physical, ours is digital. But that misses the point. Graham's real insight wasn't about what a company owns. It was about how to separate what can be known from what must be assumed. And that's exactly the problem modern investors still face. So let's return to the foundation of his thinking, the principle that defines everything that followed, the one idea that still governs whether an investment is intelligent or speculative. Benjamin Graham believed that behind every stop was a business, and behind every business was a simple question: what is it truly worth? He called this the search for intrinsic value, the real worth of a company based not on popularity or promise, but on its capacity to generate earnings over time. To Graham, the essence of investing was not predicting what others might pay tomorrow, but understanding what something is worth today. In his view, price was what you paid, value was what you received. And between the two, there must always be a buffer, a cushion of prudence he called the margin of safety. That margin wasn't a trick of accounting or a mathematical formula. It was humility, expressed through numbers. Graham knew that the future was uncertain. He accepted that investors could never predict earnings or market conditions with perfect accuracy. But by demanding a margin of safety, by insisting that the price paid was meaningfully below the estimated value, he created room for human error, market swings, and the unknown. This was the bedrock of his philosophy, that investing is not about certainty, but about managing uncertainty with discipline. It's easy to think that this idea belongs to a bygone world of factories and inventories, but intrinsic value was never about tangibility, it was about reliability. Graham didn't care if a company's assets were made of steel or ideas, only that its earnings were real, recurring, and supported by evidence. That's why he emphasized the difference between what can be measured and what must be imagined. Tangible or intangible, it made no difference if the numbers didn't hold up. The intelligent investor, Graham said, must always distinguish between substance and story, between the business that produces sustainable profits and the one that merely sells a dream. And when you think about it, that's the challenge investors face more than ever today. The marketplace is filled with narratives, innovation, disruption, network effects, all of them promising endless growth. But Graham's voice, echoing from nearly a century ago, still whispers a simple question that cuts through the noise. Where is the proof? Because until you can answer that question with evidence, not enthusiasm, you are not investing. You are merely hoping. And hope, Graham warned, is not a strategy. Let's now see how he turned that philosophy into a method, a way of thinking that can still guide us through the valuation of today's tech giants.
Benjamin Graham never saw a balance sheet filled with user data, algorithms, or digital platforms, yet his method of analysis would have handled them with the same calm discipline he applied to steel mills and tobacco companies. His process was not tied to an era, it was tied to reason. He would begin, as always, with earnings power, not the most recent quarter, but a normalized picture of what the business can earn over a full cycle. He'd strip away extraordinary gains, marketing hype, and the euphoria of trends. What remains, he would say, is the true earning engine. Then he would ask, how stable are these earnings? Are they built on repeatable customer behavior, defensible advantages, or merely on momentum? Graham sought consistency, not perfection, but dependability.
He believed that a business worthy of investment must have a proven ability to generate cash even under unfavorable conditions. Next came the question of valuation. Graham would not be impressed by price-to-sales ratios or the rhetoric of growth at any cost. He would instead calculate intrinsic value based on future earnings discounted by a conservative rate and then demand a meaningful margin between that value and the market price. That margin, his margin of safety, was not negotiable because it was the only protection against the twin forces of error and emotion. In analyzing today's tech giants, Apple, Google, Microsoft, Graham would likely approach them as he did the great industrials of his day, not as stories of innovation, but as streams of earnings with risks and durability that could be measured. He would admire the strength of recurring revenues, the efficiency of capital-light models, and the depth of their economic moats. But he would remind us that even great businesses can become poor investments when purchased without regard for price. The market, he taught, is there to serve you, not instruct you. When it offers you opportunities at unjustifiable prices, your task is to wait, patiently, rationally, without envy or fear. And perhaps most importantly, Graham would insist on one mental discipline above all: the refusal to confuse popularity with value. For him, an investment was not justified by the brilliance of its technology or the scale of its ambitions. It was justified only by the sober expectation of returns that could be defended by facts. In a world that constantly rewards excitement, Graham's method remains an act of quiet rebellion, a commitment to thinking clearly when everyone else is dreaming loudly. But how do his rules stand in today's market, a place dominated not by arithmetic, but by algorithms, social sentiment, and speed? To answer that, we must step forward into the modern world that still needs his wisdom more than ever. The modern market moves at a speed Graham could scarcely imagine. Prices change in milliseconds, driven by algorithms that trade on momentum, headlines, and emotion disguised as data. Investors scroll through charts on their phones, chasing trends that can rise and collapse in a single trading day. And yet, for all its sophistication, the market's behavior has barely evolved. The crowd still fears missing out more than it fears being wrong. It still confuses volatility with opportunity and popularity with quality. And in that sense, Graham's world and ours are not so different. When Graham warned against speculation, he wasn't just talking about day traders of the 1930s. He was describing a state of mind, a human tendency to trade conviction for excitement. In his day, that excitement surrounded the booming industrials. Today, it lives in the narrative of technology, the promise that code, networks, and innovation can defy the laws of economics.
Consider the market cycles of the last 2 decades. In the late 1990s, the Internet promised unlimited potential, and investors believed that promise justified unlimited prices. Graham's principles were dismissed as old-fashioned just before the dot-com bubble burst. 2 decades later, we saw the same movie again. In streaming, social media, and artificial intelligence. Each time, investors convinced themselves that this time is different. Each time, the correction reminded them it wasn't. What Graham understood, and what many still forget, is that uncertainty never disappears. It only changes form. Whether it's a steel plant or a software platform, every business faces competition, saturation, and changing demand. The rational investor accepts this and demands compensation for bearing that risk, a margin of safety, not just in numbers, but in expectations. In the age of intangible assets, this discipline is even more crucial, because the less tangible the business, the more tempting it is to anchor belief in stories rather than in evidence.
When you can't touch the assets, you must test the assumptions. When you can't measure the product, you must measure the cash flow. And when the crowd calls you outdated for asking hard questions, that's when Graham's wisdom becomes most valuable. The market's surface may have changed, the tools, the language, the speed. But underneath it all, the forces that drive prices remain ancient: greed, fear, and hope. And Graham's principles remain what they've always been: a quiet reminder that reason, patience, and independence are still the only lasting edges an investor can have. So what does this all mean for us, the investors trying to navigate a digital economy with century-old wisdom? It means returning to the mindset Graham considered the true mark of intelligence: not brilliance, but balance. And that brings us to his final lesson: the reflection that turns knowledge into discipline. Benjamin Graham often said that the investor's worst enemy is not the market, it's himself. Prices will rise and fall, narratives will swale and burst, but the true danger lies in the emotions that make us chase what we don't understand and abandon what we do. In his time, this meant resisting the frenzy of industrial booms. In ours, it means resisting the illusion that technology has repealed the laws of valuation. The intelligent investor, Graham would remind us, is not one who avoids change, but one who interprets it through principles that do not change. He taught that every sound investment rests on three pillars: reality, in the form of verifiable earnings; reason, in the logic that connects those earnings to value; and restraint, in the patience to wait for the right price. Everything else, trends, narratives, forecasts, are decorations on uncertainty. So when we look at today's great tech giants, the lesson is not to reject them because they are intangible, nor to embrace them because they are dominant. It is to ask the same questions Graham asked of every company in every era. Is this business truly profitable or merely popular? Are its advantages enduring or easily replaced? And are we, as investors, paying a price that still allows for human error, our own and everyone else's?
To Graham, investing was never about predicting prices, but about preparing for them. It was the art of acting on evidence rather than impulse, of finding comfort not in certainty, but in discipline. That is why his wisdom endures, because it speaks not to markets, but to minds, to the part of us that wants to stay calm while the world loses its bearings, to the investor who chooses reason over excitement, patience over haste, and independence over imitation. In a world overflowing with information but starving for understanding, Graham's message feels almost radical. Think clearly, act cautiously, and never forget that in the long run, the market is not a casino, it is a weighing machine. The form of wealth may have changed from steel to software, from railroads to networks, but the measure of wisdom has not. It is still found in discipline, humility, and the courage to be rational when others are not. Subscribe and join us in keeping Benjamin Graham's wisdom alive, one lesson at a time, for a world that still needs rational investing.